Keith, welcome back to the show. Good to see you again, as always.
Great to see you. Thank you so much.
So, lots changed since May of 2022, last time we spoke with you, including that I have a co-host now.
Howdy.
Yeah. That's right.
Hi, Corey.
So, we're gonna tag team here. But usually, when you come on, of course, we talk about trade stops, right? This is an automated way to use trailing stops and much more, of course. And I recommend most people use it, not because trailing stops are going to help your return so much over time, because they're not. But what they're going to help you do is avoid selling out at bottoms in a sort of catastrophic, panicky, in a panic, and leading to a catastrophic loss is what I mean to say. So, but today, and Keith, you're one of the few people. The list is growing, but it's still a very small list of people who can call me up and say there's something I need to talk about. So please let me come on the podcast, and I'll say, oh, okay. But you have something specific on your mind, and it sounds pretty interesting because it's a type of trading tool based on seasonality, which is not something I know or do, but I know lots of folks who keep statistics and have strategies based on this. And I know nothing about this new tool that you've developed. I can't wait to find out, though. It sounds fascinating to me. So maybe we could just dive in and start there.
Yes, let's do it. It's funny because when I think back the past couple of years at TradeSmith, we've been building a lot of different software. We have analysts that have joined our teams, and they partner with the software as well to help our customers really succeed. And we've been thinking back, over the years and sort of realized that a lot of us have taken an approach where we get worried about the market in the short term, don't want to go long, baskets of stocks, and we want to figure out ways to generate income as we go. Typically, we're looking at income with selling puts and selling covered calls, generate that income. And what we've started to coin over the past couple of years is that there's ways to leverage stocks and short-term moves, as long as they're a lot more predictable, to trade in and out of stocks, especially stocks that are great stocks to own anyway, and generate income. And so a lot of people think, short-term gains, capital gains and all of that. And that's exactly what we're doing, but we're trying to totally outpace the market when doing that. And a couple of years ago, we started to really get heavy into seasonality. And it was a fascination of mine thinking about things like the Santa Claus rally that we hear so much. We know about the January effect when all these funds and retail investors are buying in. We know that Black Friday helps us to fuel, hopefully really good sales that gets people euphoric about the stock market and, future returns. We know that a lot of times we see sales dip in different companies in January, February, and March, and that impacts the earnings releases that you see in late April to May, and you hear sell and may go away. We think about the time, it's always sometime in August, I always feel people get very bearish, and we see a lot of drops when you historically look back. And I always jokingly say that's because parents are sending their kids back to school. There's routines that have to come into play. They have to get up early. It's not fun, or they got to pay for college. So they're selling their stocks. But we have these patterns that just happen over and over in the markets. And about 2 years ago, we started to really focus on those repeatable patterns and figure out the ways that we want to visualize those patterns on individual stocks and ETFs out there. And so we were buying a ton of data. We're going through all this data, and we're figuring out that there's certain times you can look at this and say, I think I'm going to buy that stock. And a good example of that was mid-May last year in 24. I was walking around the office and I was saying, who's going to buy Tesla with me? And every person that would analyze Tesla would say, not me, because fundamentally it was not and still is not. It gets a whole lot of benefit from, what's happened with the election, but it's fundamentally a terrible stock for you to buy. And so I was one of the only people that bought Tesla mid-May and then sold it beginning of July. And I had a 50% return because I just looked at the seasonality window that 100% of the time, the last 14 years, Tesla has gone up.
I see.
And so that's sort of like a simple way to think about seasonality is we have the market seasonality, and then we have individual stocks and ETFs that behave in a certain way. We don't always know why, but they repeatedly behave in a certain way. So that was just sort of the beginning of the whole seasonality journey.
You know, the effects that you describe are so simple. One would have thought they'd have been arbed out a long time ago. I mean, it's fascinating that they're not.
Yeah, and a lot of people will sell you seasonality type of data,
Hmm.
but the thing is that you're talking about stocks that change multiple times a day. I mean, an infinite amount of times a day, but have closing prices. You have tons of stocks. I think we have 50,000 different securities in our system. So that's stocks, funds, everything. And they have all these movements, but then you have to go and you have to have massive data warehouses and be able to program in a way to determine the patterns that are repeating every year. And by the way, those patterns will change over time. And so you have to continually update that data and those patterns and reprogram them to make sure you're always nailing true seasonality periods for a stock or a fund.
That's interesting. So there may be an effect associated with a particular month or season, time of the year, but the effect could change over time. You're telling me that is that's
Absolutely.
fascinating. But and yet you're implying to me that you can still let's say we're looking at Tesla in May and June as you described.
Yep.
What you're telling me sounds like, well, one day the effect may become neutral or bearish, but for right now, it's bullish. That's what I'm hearing.
Correct.
Okay. Now
Correct.
that is
And
fascinating.
so and there's even with US presidential
Mm-hmm.
elections, certain stocks behave differently leading up to election or post election
Mm-hmm.
than they would during the other 3 years. So we pick up those sorts of seasonality
Mm-hmm.
periods. We look at stocks since their inception. So Johnson and Johnson, I think, is 60 or 70 years, and we'll look at it since its inception and find seasonality periods that go all the way back.
Mm-hmm.
But then we might want to just look at sort of what I call the modern era, which is after really the Y2K sort of time frame, and look at how stocks are performing then.
Mm-hmm.
And so with our system, we do a generic 15-year look back on every stock, but you can customize that to any sort of look back you would like. All of its history, part of its history, whatever, or election years. And we've learned that over time, you have a nice, significant edge when you have an 80% pattern repetition over time. So earlier this year I think it was February, I had presented to one of our private meetings. You guys have it's the Stansberry Editor Conference. We have what we call as our Big Idea
Mm-hmm.
Conference. So it's pretty much the same
Mm-hmm.
thing. And to be honest, we learned it from you because I've attended many of
Yeah.
yours that have been great.
Yeah.
And so, one of the things I presented to our team was I want to build a portfolio that has stocks, just stocks,
Mm-hmm.
rotating in and out. I want them to be high quality stocks, and I want them to rotate in and out during their seasonality periods, the optimal period. And I want to see us have a win rate of at least 80%. And I want them to be very short term gains. I want to target 5% gains, but I want to win at least 80% of the time.
Wow. I got to
And
stop you right there because folks who like market wizards, serious traders would say 80%, you're nuts. So that's ambitious. I mean, some of those guys are
yes,
like 40% and they're crushing it, less than half the time, and they're still winning because they stick to their winners and cut their losers short. But, uh, you know, please continue. But wow, right
yes,
off the
yes.
bat.
So as you would expect, lots of laughs.
Yeah.
Lots of people saying that's not
Yeah.
possible. But multiple people saying, hey, something a lot lower, 50 to 60%, you can have an incredible edge if you position size right, if you manage the entries and exits right, and so forth.
Right.
And it's like, yes, I know all of this. But what you guys don't realize is we have the most sophisticated data research team that you could possibly have for any retail shop out there. I would put our team against any retail shop, maybe not the hedge funds, but any retail shop.
Mm-hmm.
And so, you know, to me, it's like, I love that sort of challenge. And we went to the drawing board, and my initial thought was let's pick the best stocks in the universe of stocks, the highest quality companies, and let's go back 15 years. Any stock that has had a 100% win rate over any period of time will go into this portfolio. And we're going to test that.
Mm-hmm.
Now, here's the key about our testing. A lot of people do what I call curve fit testing. They already know what's happened, and they start to study what's happened and pick the stocks that have had returns. Right. And then they look at those and they say, okay, this is my win rate. This is how I performed and so forth. What we did was wildly different. We went all the way back and started at 2006. And then we looked at 15 years of data prior. And we judged those 15 years and we automated the entire process. And we asked it to tell us which stocks to trade in and out of the next year based on that 100% historical win rate. Then we said, now it's 2007. Go back 15 years. Do the same thing. And we built this portfolio over 18 years with a starting look back of 15 years prior. That portfolio won just above 60% of the time. And I'll be honest with you, it took us 5 weeks to get the testing and get all of that set up. And I could not have been more deflated because I wanted to win 4 out of 5 times, not 3 out of 5. And the key with that, you guys know how customers behave. People, they don't take every trade you would make. Mm-hmm. They cherry pick. And that's fine. But if they cherry pick only winners, that's great. If they cherry pick only the losers, that's awful.
Right.
And so
they'll blame your system.
In the back of my mind.
It's crazy.
Exactly.
They'll blame your system even though you're doing like 60% winners or something. It's crazy.
Exactly. And I was so excited about this product. I wanted to release it early last summer. And so here I'm thinking to myself, I feel so let down, but we're not going to do it. Let's figure this out. So worked with the team. We basically had an all hands on deck for about 4 months of time. And we started to run testing after testing. The first test that was finally starting to get significant only took us 1 day. In the end, we ran something like 2.24 quintillion tests. Now, remember, this is 6 months ago. Mm-hmm. So what did we do as a software company? We built software to go and look at optimal seasonality periods. We built the software in a way where it could continually just test permutation after permutation, factor after factor, and tie that along with seasonality to find the optimal windows to trade in. And we got to the point where we were running 50,000 tests in a day, then 100,000 tests in a day. And all we had to do was write a program to interpret the results of the tests to figure out which results were worth looking at. And so we tried to pull out all human bias. We pulled out all bias on the back testing. There was no curve fitting. Mm-hmm. And we looked at how can we get this thing to above 80%, and we're not stopping till we figure it out. And the craziest thing was it ended up being just 2 different things we had to look at. Number one is for every stock in our system, we had to build an algorithm, and we automated all of this. We had to build an algorithm to find what we call the most optimal seasonality period out there. So it's not always going to be 80%, might not be 100%, maybe it's 92%. We were asking the system to tailor this for every stock and find when seasonality has X% of a win rate over historical 15 years prior for the next year, how did it perform and where's the place where it won the most? Then we looked at every technical factor you can imagine, and it turned out that there's a custom RSI, Relative Strength Index, value that we can associate with each one of those stocks. But again, it's custom for every stock. Apple, RSI might need to be above 60. Tesla, RSI might need to be below 40. Mm-hmm. And so we figured out what is the optimal combination over 15 prior years to get us to a much more successful win rate. In the end, and I'm going to pull up numbers so I don't misquote this. The team gets upset, and they should, if I misquote these numbers. In the end, we got to an 82.83% win rate. So more than 4 out of 5 winners. Our median trade was about 6%. Our days held was on average 15 trading days. So that's about 3 weeks to get that. And we turned $10,000 into $85,700 over 18 years. So that's an 857% return over 18 years. Now, here's a really important point about that. Most portfolios are managed in what we call rolling gains. If you start out with 100,000 and you get to 200,000, you don't go back to 100. Because we wanted to make sure we were as conservative as possible with the testing, our legal folks were happy. You guys know what that's like. We actually kept starting with just $10,000 every year. We never, when we won, rolled it. We always started with the same amount to get to our win. So the bucket of wins was a lot higher if you would have done even normal portfolio management and just managed your capital as you typically would than what we even put out. And so, for us, it was just, it was such a magical
Keith.
moment.
I want to make sure I understand that point about rolling.
I know, I get so excited.
No,
it's okay. Running on
it's
here.
okay.
Yeah.
It's okay. So are you saying that you started with $10,000 15 times and the total gains were 80 something?
We basically started with, I should have clarified. Sorry. We started with $10,000. We never added more money to it.
Okay.
So we basically started with $10,000. We did equal weighted positions across the board throughout the year. And we had typically 30 to 50 trades. It depended on how much movement we got and what the algorithm said. And we turned that initial 10,000 into 85.7.
Okay. But I don't understand the point about rolling and not rolling. I mean, if you start with 10,000 and you make, 10%, then, you've got 10,000 plus 11,000 at the end of the first year.
Right. You have 11.
So
we then don't use 11. We keep using only 10. We put all the winnings into a bucket and we never touch them.
Okay. I see. And you wind up at the end of 15 years with?
We start with 10, we end up with 85,700.
Okay.
So you're not compounding the gains.
We're not compounding the gains, correct.
All right.
Got it.
Interesting. So if you did compound, you'd be through the roof.
Yeah, I forget what the chart was when we first looked at it. When I first saw it, and when I first saw it on just winning 60% of the time, it was incredible. But it didn't meet what our criteria was for the seasonality piece for the portfolio. And so we, when we kind of started to go further and we start working with legal on how are we going to tell our customers about this, what is okay to say, what's not okay to say, they were like, we don't want you compounding gains. We don't want you rolling those gains into further gains. And, my argument is that, hey, that's portfolio management. But at the same time, I didn't care because this system was so phenomenal in the way we built it and how hard we worked on it and the results that it was like, these gains are great. Who wouldn't want to take these gains?
It sounds to me, though, that when you say you started with 10,000 at the beginning of 15 years, I mean, it sounds like you're investing 150,000 and making 80,000. It doesn't sound to me like, you know what I'm saying?
No, yeah. So I see what you're saying. So you start with 10.
Yeah.
Let's say it ends up being 20. You use that same 10, but the other 10 goes away into a bucket.
Okay.
You've never put in more capital out of your pocket than $10,000 initially.
Right. No, I get it. Right. You're starting with the same. It's the same $10,000 is the reason I'm wrong.
Correct.
Okay. Wow. Okay. So, now that we got all that taken care of. Wow.
Yeah, but I mean, 80%, or plus win rate, and I think what we've talked about this with the market wizards people and technology too, just having to keep up with the advances in technology and I think and tools that people need or feel like they need, and for like a short-term trader, this seems like
right.
Why would you not want to try this?
Yeah, absolutely.
All right, so I have to ask certain questions. One of them is testing is great, and you've obviously done more testing than you're doing quadrillions of tests. I mean, that's a lot of testing. Testing is great, but it's not trading, is it, Keith? I mean, it's
correct.
Yeah. What's different about trade? Trading involves, whether you like it or not, it involves human emotion, and you really got to stick to that system and just trade it like a machine to be able to expect a similar result, right?
Exactly. So what we do in our system is we start with the 50 top stocks that our system has identified for the year.
Mm-hmm.
We have optimal entry and exit points that you can see on a calendar that are predictable. And the only thing that tells you whether you enter it or not is that custom RSI feature that says enter it or not. Then we have a very specific exit date that you will get an alert for. So you get the alert to enter,
Mm-hmm.
you get the alert to exit. And then we have an analyst who does a write-up on why the system picked that and tells you to stick to the entry and exit no matter what happens. And so that's where the human bias has to totally be, thrown out the window. Is you can't break the way the system is going to tell you to trade it.
Mm-hmm.
Every time we tried, by the way, when people would say, oh, we should put this sort of trailing stop, could we get 10% average gains? And it's like, no, the system couldn't find that. We can get 6% average gains. That's wins and losses.
Mm-hmm.
And so you have to follow the system. You have to trade it the way the system is telling you to trade. The whole reason it's optimal is because that's what the system has identified.
Right. And to be clear, you're talking about an average of 6% in 3 weeks, right?
Correct.
A 3-week
Correct.
trade. So it's, annualized, it's through the roof. It's enormous.
Correct. It was well over 100% annualized.
Yeah. So, wow, again. And it sounds like, so, with a typical, typical newsletter, like what I write and like what a lot of people do, I basically send you a story, a write-up, a report, with all the reasons why I think, company XYZ is a good
Mm-hmm.
bet. And, at the end I say buy company XYZ. And, that's what you get each month. What you get here sounds different. It sounds, I'm not totally clear on it, but is there a level of interactivity, or are you just being told, or is there just lots of information about when a trade comes in? What's my interaction as the consumer of this tool?
All right, great question. So there's a couple different sort of interactions. There is the let the tool fish for you,
Mm-hmm.
which includes an analyst behind the scenes who we really think of as sort of Sherpa. He's your Sherpa to get you through it, right? Or do you want to fish for yourself, or do you want a combination of both? So for starters, the seasonality portfolio and all of the seasonality, all the different screens that we have in a system are all part of a product that we call trade cycles. And we have an analyst that's sort of at the helm of that. And he is looking at broad market things that are happening with seasonality and cycles, and also other, different factors that he tracks, and giving you write-ups weekly about that. He then has trades that he favors personally, kind of what you guys typically would have, but not from a fundamental perspective. He's looking at short-term gains based on different cyclical patterns, based on different technical factors and so forth. But then he's helping us to sort of Sherpa through this portfolio of trades where he's telling you why the system picked a trade, an entry point, or an end and exit point once you've entered. And so you sort of get it all, or you can go into the system and find your own and develop your own portfolio of trades based on this trading in and out. So somebody could even look at your portfolio, Dan, and say, okay, do I want to get into that stock now? Is this an optimal time seasonality wise? Because I'm not ready to buy a stock for the long term that Dan recommended, but I like it fundamentally because of Dan. So you can sort of do everything with this. You can wait for the analyst to do the write-up and tell you exactly which stocks to enter and why, which will all be technical reasons, and when to exit them, which will be technical reasons. You can look at his specific trades over the whole market. He does a lot with the QQQs, SPY, and so forth. Or you can sort of dive in and look in the system and develop your own type of trades. You can look at Apple and say, is this the time of year I should be buying Apple?
Cool. Yeah, I was going to ask you about the overall market too, applying this to the overall market. Seems like that would be something you can do and maybe should do as well. What have you found in terms of seasonality in, say, the S&P 500 or the QQQs? Just like something that, I don't know, an observation that you guys have discovered.
Yeah, actually, it's funny when I was looking at these sort of patterns about a year ago with our analyst, it was so obvious. Like the whole, like every single August, he's looking at the market, comparing its seasonality to the August before, and it was very specifically around August 15th. And he's seeing, is it the same setup every single year? And it almost always has been. And so he'll do these write-ups that talk about 93% of the time over the last 85 years. I just made up those two numbers, but it's something like that. The QQQs have dropped 5% or more August 15th through whatever the time frame is, right? And so he'll then issue you a trade. You could just basically buy the inverse of the QQQs, or you could do an options trade. You could buy a put on a QQQs and so forth. And so he'll issue a trade with all of this fascinating explanation. He does way better than I could ever do explaining that, talking about that sort of cyclicality in the QQQs mid-August. And we saw it for the election. He had a really cool write-up for the election around the S&P 500, Dow, and NASDAQ. He did a great piece for December talking about why we're going to be in a rally. So it's really fascinating the way he pulls everything together at a high level.
Yeah, that is cool.
Right. And do you care about the reason why, in August? Like were you able to link anything together, or does it not matter?
It really doesn't matter. A pattern's a pattern.
Yeah.
And so like if the market is sort of overbought at that time frame, and it does the same thing every year when it's overbought, you can sort of bet that it's going to go down.
Keith, to what extent, obviously, a lot of people do this sort of thing. The folks at Renaissance Technologies who made like 80% a year for 20 years do a lot of this type of stuff too. To what extent do you think it's a valid observation or not? I don't know because I'm not in the data the way you are. But do you think that there's a chance that, like, looking at this history and imputing these probabilities, there's something feels a little bit odd about that to me. It feels to me like saying, well, this happened for the last 15 years, 100% of the time. And the first thing I start to think of is, well, 15 years doesn't sound like a long period of time to me. And the second thing is just, well, because it's happened several times over the last 15, 20, 30 years, and we're admitting we don't know, like, why, we don't know why these things happen. It feels like it's like we have faith in markets or something. We have a belief that they just behave a certain way because, we don't really know. I'm having trouble formulating a question, but it all feels a little funny to me.
Yeah, I totally get it. Let me tell you why it feels funny to me too.
Okay.
When we first started to hop into all of this data, it seems so obvious that if something happens repeatedly, it's likely to happen again.
Mm-hmm.
And we found that's only true 6 out of 10 times. And that to me felt like a failure. And so you're basically saying, okay, this happened 100% of the time, but then going forward, it only happened 60% of the time this year. And that right in and of itself says exactly what you're saying, Dan. It feels really odd to me that we would trust 15 years of data to say something's going to happen. Why would it happen again?
Right.
When you start to study every single individual factor that's out there and combinations of all, and that's how we got to the 2.24 quintillion tests. When you start to study all that, which was automated, I just want to remind you, because you can't physically study all that.
Oh, quintillion. I said merely quadrillion. Quintillion. Sorry.
Yeah, I couldn't even tell you which one's higher. It's
I know.
tests.
Yeah,
but
me neither.
Once we got to 1 billion, I said I'm sort of set.
Yeah.
I think we've done enough. But and the best result was way earlier. It just, you have to go through all the permutations to figure out what's the right way to do it. What we found was that there's the RSI was the simplest way. The 14-day relative strength index was the simplest way to understand if you should confirm a seasonality period for an individual stock, any fund, the market, whatever it might be. And it was rare, 1 out of 5 times, rare, maybe that's not the right word, but it wasn't often that it would buck the trend. And so when you think about something like the QQQs dropping mid-August every single year, you can look at the other technical factors to say, why was it that they were dropping that period of time? Mm-hmm. It's not just that there's a seasonal thing. Mm-hmm. There's got to be something about August. I don't know if people are in a funk. end of
Yeah.
August. I don't know what it is. There is something about August that causes that. Just like people are excited in December, it causes that, right? But the reality is, were more people buying stocks or selling stocks at that period of time? And what was the rate of change? We look at that sort of rate of change.
Mhm.
So if you're overbought, everybody's bought the stocks and people start selling and they're just selling more aggressively, you're just pushing the stock prices down. You're pushing the index down.
Right.
And so it's really the combination of factors. It's not just seasonality, but it's that combination of factors that gives us the confidence to say, okay, is this a period of time that we want to write about or we want to make a trade?
So it's ultimately, I think whatever my question was, I couldn't formulate it, but whatever whatever it is, it's just a funny feeling. Um, Ultimately, what you're telling me is that you've just studied enough data and run so many, quintillion of tests, that you are very comfortable imputing these probabilities, and gosh darn it, they've worked during the periods you've tested. So why wouldn't we
Absolutely.
trade them? Why wouldn't we? And that's and I'm not saying I know anything, by the way. I'm just admitting ignorance here because I don't operate in this quant world that you guys operate in. I mean, I use various mathematics of some sort, arithmetic mostly, but it's in a different way. It's about fundamentals. It's not
Yep.
about price action and time as it is with you. So it fascinates me when people like you, when I get someone like you, it's like I got to hit you from every angle so I can try to
Yeah.
understand what the hell's going on. But I want to get back. I'm going to get back to the interaction between me as a consumer of the tool and what I get. How often, if I'm a Trade Cycle subscriber, how often I can interact with this tool anytime I want, or do I hear from you periodically, like weekly or something?
All right. The answer is all of the above.
Okay, I thought so.
So you can interact. Yeah. You can log into our system. You can look at every single stock and fund that we cover that we have well, you can look at every stock that we cover, but you can then drill down to see which ones have seasonality data, which is most.
Mhm.
And then you can go and look at each of these periods of time and just select them. And you can see what's happened in the past.
Mhm.
And if the system is saying this is an optimal time to trade, because it's not always optimal, as I was telling you guys earlier.
Right.
So you can do all of that on your own. You can set up what we call watch lists, and you can get alerts on those stocks. You can get alerts to trade in and out. You can do all of that on your own. You can take the total opposite approach or a hybrid approach, and you can just wait for us to send you weekly updates. Those weekly updates will talk about the markets, what's happening in the markets, why it's happening. And it'll be mostly from a technical perspective, but with some flavor about what's impacting and driving those technical factors.
Okay. What my next question?
From there, yeah,
Before you go
yep,
any further, I just want to ask you, Keith,
yep.
whether I'm just sort of self-directed or waiting for you or hybrid as you're describing. Is that all the same subscription, or am I different levels?
All the same.
It's
This is what I think is probably going to be the most confusing for people. This is all the same subscription, no levels. We wanted this to cover everything. This is our cycles trading product that's focused heavily on seasonality.
so like one
and
price,
technical
one
factors.
subscription, and this I can do it any
Exactly.
way I want. That is cool. I
Exactly.
like that.
And I think I would bet the majority of people will do the hybrid. We're going to be issuing trades. Sometimes those trades will be more broad market type
Yep.
trades, like buy this put on the QQQs or go long on this inverse QQQ fund in August, right? A lot of times it'll be very specific trades. Our analyst loves oil trades. He does very specific trades on oil based on its cyclicality and what's happening in the oil markets. But then he will be telling you about the automated trades that the portfolio is spitting out. My only rule for him is you don't mess with the automated trades. We did so much testing.
Very good.
You're not allowed to mess with the automated trades.
Yes.
So if you think about, maybe we should break it down into three ways. We have the analyst focus on weekly updates and his own specific trades with information that you can make.
Okay.
Sometimes it's one trade a month, sometimes it's 4. It depends on that month and what's happening.
Okay.
Then there's the automated portfolio of trades that his job is to relay to you everything that's happening and why, and tell you what the system's telling you to do, but not alter it no matter what he thinks. Then the third way is you can log in. You can look at any stock or fund you want. You can build your own portfolio of these things. You can get your own alerts and do it however you want. And what people I think will do is a combination of all three.
Yeah, that sounds, I think you're right. I think most, everybody wants to tinker with the system themselves, but they want to know what the guy who created the system has to say. And the point about making darn sure that this guy does not mess with the system. Don't mess with, that's so important. I every now and then I tell a story about visiting one of the turtle traders and having them show me one of the outputs, a trade that was output by their system, and having them say, but I don't really want to do it. And I thought, what? You don't really want to do it? So, I was like, So they told me there was no discretion, but there is discretion. But you're saying no discretion, trade the system, period. And I love that because that makes sense. Because once you get to the discretion, you get to the emotion, right?
Yes.
Yeah.
And we have one more layer of this big Thanksgiving dinner that I haven't told you about. Okay. This is the gravy. For probably 20 years, I've been one of those people that I wouldn't say I'm scared, but I didn't believe in buying calls and buying puts. I believed in selling them for income. I believe most of them expire worthless. I think there's a whole, incredible time value principle that you can sell very short-term puts that expire worthless, let's say in a week to two, and make a lot of money over time. We developed an entire system around this called Options 360 that's been live for 4 years with a 95% win rate. So I know, tried and true, the way that you collect income or trade options is by shooting for income. When we got to the point where we had an 82 point whatever, hold on, let me look at my notes, 82.83% win rate, the head of my research team, who has worked at funds before, said, I think it's time for us to build a call buying strategy. And I said, no way. And he said, Keith, he said, listen, when you have a short-term gain like that and your average returns are even just 2 or 3%, if we can get you the call at the right strike price for the right amount of money, you can make 1 to 200 to 300% in that short 15-day period of time. We have to time the entries and exits of the call buying to that stock seasonality period, and we have to have a certain window of time post the seasonality period where the actual option would expire. And so I sent him on a mission to prove that he was right and I was wrong. What he came back with was he developed an algorithm. We have 16 years of options data that we could test through. And as you guys can imagine, one stock can have 1 billion rows of options data for 16 years because we have every price interval. It's crazy.
Every strike, every expiration. It's insane.
Oh my gosh.
It's insane.
Yeah. And the interval changes so much during a day. You can't even take averages. You can't sit there and say this was $1 this day, it was $2 this day.
No,
I mean, it's like it could be
you would spend your whole life doing that. Yeah.
It could be $1 at 10 a.m. It could be $5 at 11, and then like pennies at the close. So he was able to develop an algorithm, and again, this is custom for every single stock, to find the most optimal call to buy. He had a 60% win rate. Now, that does not mean that 40% of them expired worthless. Even if they lost 1%, it's still a loss. 60% win rate turned $1,000 into $250,000 over 16 years. So I don't know I think it's like 25,000% return, something like that. He started with just $1,000 and never once dipped back into his pocket to get money. Started with just $1,000, put all the winnings into a bucket. If he ever lost that money, he pulled it out of the bucket of wins. No rolling.
I see.
$1,000 into $250,000 over 16 years.
Gotcha.
So what we do in our system is every time we trigger a buy of a stock based on the optimal seasonality period with the optimal RSI for that stock, we will tell you a call option you could buy as well. And these call options hopefully are just, $100 or less than a couple $100. And it's a way for you to get some serious sort of alpha out of those stocks if you want to buy that call option. We're currently working on the opposite of that, which is selling puts for income.
Mm-hmm.
That would be a lot closer to the money versus our normal Options 360 program
Mm-hmm.
that goes a lot further out of the money to get the 95% win rate.
I see.
So
Well,
that is gravy.
yeah.
It's part of the product as well.
Well, if that succeeds, it'll be a first in our business. Like the only it was basically a revolution in our business when whoever it was that started it, just started selling puts and saying, don't ever buy
Yep.
them. Don't ever buy calls. Don't
Yep.
ever buy puts, because everyone before, all the options trading products before that, they'd get a streak, and then they'd claim that streak was representative of the system, and they'd sell a bunch of subscriptions. And of course, the streak isn't representative of shit, and you get killed, and everybody would cancel their subscription and be extremely unhappy with you. And then people discovered income, and that's the only way to do it consistently. People like to make a little bit consistently and not lose, when it comes to
I
things.
agree.
So if you do this, Keith, I mean, I got to have you back just to talk about that and nothing else, because that'll be a revolution in our industry. It really will. And
I would love to.
I wish you well with it. And you're right. It's like,
Thank
if the rest of that is the Thanksgiving dinner, I don't know. That is some serious gravy.
Yeah.
That is serious gravy if you can pull that off.
Yeah. And what I want for people, I want to make sure this is clear too, because it's all about position sizing. Yeah. What I want for people to do is take the tiniest, less than 1% of their portfolio.
Absolutely.
To play with that.
Yes.
And I want them to do it consistently. Yep. And I want them to start with something like $1,000 and never pull back from their wallet. If you first of all, if you can afford a product like this, you can afford to take $1,000 and speculate with it. And if that $1,000 can turn into $5,000 by the end of the year, that is the most wild success you'll ever see with options buying. Most people will put 1,000 in, then 5,000, then 10, and they just watch it all vaporize. Mm-hmm. And so I want people to position size this right according to their risk tolerance and so forth. But honestly, I want you to put less than 1% of your portfolio into something like this.
Yep.
And I want you to be very regimented about it.
Yeah. And even 1% might be a lot for some people, depending on how much money they have. And you're right. Yeah. And I'm glad you got here, because this is an extremely important point. I mentioned earlier in our conversation those market wizards traders who some of them win less than 50% of the time, and they still make plenty of money compounded over many years. They always get here. They always, in the conversation, they're always like, position sizing and management of the position, like the stops when you exit. And they all said that's far more important than the entry. But what you've done, is you've done, whatever it is, 2 or 3 quintillion tests on making really great entries. So if you add that discipline, that trading discipline, to really great entries, it sounds like, and stick to it with an absolute iron discipline about the system signals and iron discipline about your position size. It sounds to me like you got something really cool there, potentially super cool.
Yeah. And that's the key. I'll tell you, if we didn't have those limits on the call buying, it probably would win 10% of the time, 20% of the time. And you'd be lucky to even get close to break even at that point. And so I think that's the wild difference when it comes to a lot of these different services out there, is they say, okay, let's go ahead and buy this. And then you got to wait. And then they say, oh, we're down 90%. Let's sell it. And so this is a very regimented, automated way to tag team with the stock buying and selling an optimal option that's a call option to buy and sell alongside of it.
Well, I can't. Is this okay? So let me ask you a question. I'm not clear. Is Trade Cycles out there? Is it ready? Can I subscribe right this minute?
Out there. You can subscribe right this minute. Okay. I'm sure that our team will get you a link for it. It's out there. and it's ready to go. It's actually technically been a product that we've had for about 5 years now. It's just taken many different twists and turns.
Right.
And then we redeveloped the entire thing from the ground up starting about a year ago.
Okay.
So it has a whole lot of really rich history. The software side of it, the website you log in, is fully complete. The portfolio management is there. It's built on top of all of our TradeSmith sort of engines that care about all this sophistication and making it very easy for the consumer to consume once they log in. So it's what I call a mature, redone product.
Okay, good. I mean, I obviously I can't keep up. Like under the MarketWise umbrella, there's a million products, and it's just like
Yes.
absolutely. The fact that I didn't know that it exists for 5 years, it sounds like I'm stupid, but I just wanted the listener to know there's no way I can know all this.
Yeah.
Well,
Well,
nobody
I
knows
also
all
think
this.
I would expect Greg Diamond to know about this system.
Oh, I bet he does.
Right?
Yeah,
Yeah,
I'm
yeah,
getting a powerful whiff of Greg
similar,
Diamond out
yeah.
of this. Yeah.
Yeah.
Yep.
So if you're into Greg stuff, I mean, it's right in that ballpark. Like it's
Yeah.
and to his but the difference, I think one of the differences being here too is just the system involved, and staying regimented with that system. I'm glad you got to that point too, because that's really like when you're able to have the entry exit points within a broad portfolio where it's all doing the same thing all the time, where your computers are running in the background all the time. That's doing all the risk management for you to get to those tested returns that you were talking about.
It's so
absolutely.
inhuman though to have that kind of discipline.
It's
isn't
totally
it?
inhuman.
I mean,
It's like opposite of what you should.
Yeah.
It's the how many times do you want to, like, you're, even if you have conviction in a trade and it's down 10%, it's like, oh, it's gut wrenching,
Yeah.
right?
Yeah.
But this is how you overcome that, I suppose.
I mean, look, I've been using trade stops for forever, and trade stops is the only reason I can even think about that and really model a new product that has smart entries, exits, and position sizing, because it's just been ingrained in me that I am a terrible investor and trader if I'm not regimented.
Right.
Terrible, awful. You could give me the best piece of advice ever, and I will screw it up if I don't have that sort of regimented approach that I've learned over the years.
And really what we're saying is, Keith says he's a terrible trader. Like we all are. Humans are. Human beings are
Yes.
terrible. That's the point. The point isn't that Keith is brain damaged, because we all are brain damaged in that way. We human beings. We all want to sell at the bottom and buy at the top. Like you said, Keith, people who have that mentality. We were talking earlier, I think, before we hit the record button, and we were talking about people who ask you for tips. And I admitted that my father had periodically over the years said, how can I make a quick $5,000? and we agreed, like, that mentality buys at the top and sells at the bottom. Just don't do it. But a lot of people, I've mentioned Market Wizards, and Keith's system does this. They have found a way to just sort of extract that human emotion. I mean, humans build these systems, but they're for extracting that emotional element that gets you scared at the bottom and euphoric at the top, and replaced it with a disciplined system of entry and exit and position sizing. In this case, based largely on seasonality. Entirely on seasonality, Keith, or just largely?
Seasonality and RSI.
Okay.
And then custom views of that per stock and fund.
I see.
It's different for no two stocks or funds are the same. So no two algorithms end up being the same for them.
Wow. Yeah. So it's very sophisticated, obviously. And I guess, good traders, a lot of good traders have a lot of this stuff in their head, but nowadays computers are doing, a lot of the work. And even, I told my little story about visiting the Turtle Trader many years ago, 20 plus years ago. Even they had, like, the floor we were on had the trading, the trading floor, but then the floor below that was a whole team of, like, mathematic and computer science PhDs working on the system, creating the system. So this is how you do it. You do 2 or 3 quintillion tests on a lot of data, and then you stick to what it tells you, and like with iron discipline. And it's just that
Yep.
easy, isn't it, Keith?
That's what I feel. It's funny because we'll be total opposites in this. I can look at numbers of a company
Yeah.
and I can take things that I've learned from you, Dan, or from other people around the industry, and I can look at something and say, oh, this feels fundamentally good or bad, right? I can even program that based on numbers.
Right.
I could never in a million years do the type of research you do on a company to figure out should I buy that company or not. And
Well,
it's just that's like the reality of how our jobs go,
yeah.
right? Like this is what I do from a quant perspective, but I can't do that research
But you
like you would do.
you could, but it's just not you. That's not Keith. That's
not
the
me.
Dan thing.
Yeah.
That's not the Keith thing, right? And that's important, because finding out what I've made this point a lot in the digest, Corey and I talked about it on the show. Your investing is very personal to you, and having all these tools like trade stops generally, just all the products that you sell generally, are actually it's a pretty decent way, looking through those products, it's a pretty decent way to help figure out what kind of investor you really are. If you're, and this obviously, when you combine seasonality, RSI, 3-week trades, average 6%, that gives you a feel for what you're in for. And if that sounds like you, it feels like you, and I'm sure a lot of people listening will say it feels like them. Then that's how you know what you want to do. And if learning about companies with wide moats and good fundamentals that I believe you can hold for the long term, that's what we do in Extreme Value. And I do a little bit of that, not a lot, in the Ferris Report. In other words, I guess I'm saying what we say often about market-wise generally is that no matter what kind of investor you are, you will find your style represented by somebody who really knows what they're doing. And if you're a trader, and we've said this a lot, if you're a trader, like you need something TradeStops has to offer. If you're a trader, I don't.
Yeah,
TradeStops is selling something you have to have. I'm sure of it. And this sounds pretty cool. It's amazing that you've done this.
Thank you.
It really is.
Thank you. It was an incredible feat. I could not have done it without our team. We have over 70 people on the team just dedicated to our software research and data.
Wow.
I mean, it's great. People don't realize how big we've gotten over the years.
Yeah, I didn't.
And it wasn't until about 4 years ago. Wait, we're 2025. Yeah, 4 years ago, early 2021. It started in 2020 where we started building the options program and realizing that, processing billions and billions and billions of rows of data, that we needed a much more sophisticated team. We started hiring people. We started hiring, PhD level researchers, all these sorts of things. And what happens is you achieve something you thought was never achievable. And then it's like, well, what do we do now? And so it just starts to snowball and compound. And that's how we got to a point where we could do this. We couldn't have done this a year and a half ago. We couldn't have even done it. It was pretty hard to do a year ago. And it wasn't until the summer that we had the big breakthroughs, got new team members that really helped us use some machine learning, although that didn't end up being a part of this. But we had to use some machine learning to start to put us on the right stage of how do we even test this better.
Wow. So how long has this new improved trade cycles been available, Keith?
So the seasonality part of it's been available for about a year.
Okay.
But then this new portfolio version of it has been available for probably about 3 months internally. We've been beta testing it, and then about a month for our subscribers that already had trade cycles.
Okay, I see. So it's even a year. I mean, it's still pretty new. Do you have data on how well folks are doing with it, or how well, like, trades that you're putting out maybe?
Yes, absolutely. So we have so the gentleman, his name is William McCandless, that is the analyst for this service. He does this incredible job of every time he puts out a trade, whether it's a win or a loss, he asks for feedback, and he wants that feedback, and then he shares the feedback with others. So the overwhelming majority of the feedback has been, I won this. I made $13,000 on this. I did this. I had a 212% return here. I mean, we have more feedback for William's work in this service than I feel like we have for all of our other services, maybe combined over the same period of time. And William's been doing this for, I think, maybe a year and a half with us, maybe closer to 2 years with us. And he's had that sort of style in his editorial where he's just constantly telling you about something and asking you for the feedback.
Interesting. That's really cool.
Cool.
Yeah. Especially with something that's like, short-term oriented, you can get a lot more feedback, right? And it makes sense it makes sense, in other words, for short-term trading product to constantly be, asking for feedback. Whereas I'm like, with extreme value, I'm like, okay, just expect nothing for at least 3 years and then tell me what you think, what I'm saying? So, because, it can take a while. You find something that's undervalued, but different conversation. Okay, Keith, we are actually to the point where it's time to ask our final question. And our final question is the same for every guest. You've actually answered it before. I hope you don't remember it because it works better that way, in my opinion.
Yeah, I don't quite remember this.
Good. Very good. Same question for every guest, no matter what the topic, even if it's non-financial. If you've already said the answer, by all means, feel free to repeat it. And the question is simply, if you could leave our listeners with a single thought today, what would it be?
Cool. A single thought. Okay. And then, just thinking about this. So this would be my single thought that's very broad, and it would cover every type of person out there. But a lot of people hopefully are well past this. But if so, I want them to pass it on to other people they know that aren't. Maybe it's kids or grandkids. This is the thing that's the most important to me, especially because of the journey I personally went through that was lucky enough to end probably about 15 years ago when it came to managing my own finances. Number one, get out of debt. Do not be somebody else's interest. Don't let them be an investor off of you. Number two is build up your savings. Start with some level of a rainy day savings so that you can cover things, make sure you have somewhere to live, eat, and take care of your family. And then get to step three, which is investing. So it goes debt, get out of debt, get your savings, and start investing. And when you get to that investing, you have to be regimented. You have got to care about how much you're putting into every single stock or fund you buy, why you're even buying that in the first place. Please have a reputable reason to buy it in the first place. And you need to know when you're going to sell it before you ever even buy it. Typically, a trailing stop is the best way. So you got to be disciplined when you get to the investing stage. But the ultimate discipline starts with not being the leverage that somebody else gets to make money off of you by carrying ungodly amounts of debt throughout your life, because you will never, ever, ever get ahead if you're carrying that debt.
Brilliant. Perfect. Excellent message. Listen, Keith, thanks so much for being here. It's always a pleasure to talk with you, but this was really kind of an exciting and informative conversation. I hope folks were taking notes because you gave us a lot of information. And of course, they can all go to, we'll get them a link, but you can go to tradestops.com and find out about trade cycles. Thanks a lot, Keith.
All right. Thank you both. Really appreciate it.
You bet.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.